Good afternoon, with Dave Schiller with Aegis Wealth Partners here. I am the owner of the firm. I'm a certified financial planner. I'm also an enrolled agent, and I hold a few designations in both college planning and in student loan repayment. Today, I wanted to talk about education tax credits. Specifically, I want to go over the American Opportunity Tax Credit. So for those families that are getting ready to send their children off to college, whether it be this coming year, next year, or even in the next few years, this is certainly a tax credit that you'll want to know about, and hopefully you'll be able to manage your AGI so that you'll be able to claim the tax credit. So let's go ahead and go into what it is, how to claim it, and some more of the details that you'll need to know. So the American Opportunity Tax Credit, or AOTC, is what's called a partially refundable tax credit. So this is a very valuable type of tax credit. The maximum amount that you are able to claim is $2,500 per eligible student, and 40% of that is refundable. So what does that mean? So if you're able to claim the full amount, you are able to reduce your taxes by $2,500. But if they're reduced to zero, and you still have tax credit remaining, you can get a refund of up to $1,000 back to you, and so that's going to be the 40% of the $2,500. Now, how do you become eligible for the AOTC? Well, first of all, your student has to be enrolled at least half-time in a degree, certificate, or some other credential program. The student cannot have a felony drug conviction. And the thing about this tax credit is that you cannot claim it for more than 4 tax years. And that means that it's only available for undergraduate studies. And if you've completed 4 years of post-secondary education for that student, then you're not eligible to claim this deduction, this tax credit. So you cannot claim the AOTC. There's another tax credit called the lifetime learning credit. You can't claim both of them for the same student in the same tax year. However, if you have 2 students in college or some other type of program that is eligible for these tax credits, you can claim the AOTC for one and the LLC for a different student in the same tax year. Again, just not claiming both of them for the same student in the same tax year. So what is an eligible institution? It's going to be most public and private universities. There's going to be a lot of vocational schools and some other types of post-secondary institutions as well. The key thing here that's going to determine the eligibility is whether the university participates in the federal student aid program that is administered by the U.S. Department of Education. So if that institution does disperse federal financial aid, then likely it's going to be an eligible institution. So doesn't have to be college. Again, it can be vocational or other type of institutions. So how do you calculate the tax credit? Well, first of all, you have to determine what your qualified education expenses are. If you have $2,000 of qualified education expenses, you'll get that at 100% credit. For the next 2,000, so for amounts 3,000 to 4,000, you'll be eligible for 25% of those expenses. And again, remember, this is per eligible student. So the question then becomes, what are qualified education expenses? Well, it's going to be things like tuition and certain other expenses so that you can be enrolled or attending the school. Books and other course fees are eligible. A couple of points here that are important and that you might run across in your own situation. So if you're taking out loans for the student, so let's say you as a parent are taking out student loans on behalf of your student, you can still claim the tax credit because ultimately you are going to be paying those loans back. Also, if you have any type of gift or inheritance money, that is also acceptable. And a key point here that you might see is if it's a third party like a grandparent. A grandparent wants to help. the way that works, even if the grandparent pays the school directly, the dependent student is considered to have received that money first before paying the university or other institution. So you are considered to have paid that expense. Now, what are not qualified education expenses? So room and board, any type of transportation, insurance and medical expenses. So universities have been tacking on different insurance or healthcare expenses. Those are not eligible. Also, anything that's paid with a 529, scholarship, grants, or even some sort of employee tuition reimbursement plan, those are not eligible. You'll have to back those numbers out to determine what your qualified education expenses are and what that dollar amount is after you subtract any of these types of sources of payment. Now, this tax credit is also subject to income phase out. So if you are single, if you make $80,000 or less, and you are eligible for the full credit amount, whatever that is, $2,500 or less. If you're making between $80,000 to $90,000 as a single individual, then there will be some sort of phase out. For example, if your MAGI is $85,000 and you have $2,500 in eligible tax credit, it'll be half of that, so it'll be $1,250. Anything above $90,000 for a single filer, you cannot claim this tax credit. And for married filed jointly, those numbers are simply doubled. But here's the thing that you need to know. So for some families, if they're getting into more sophisticated types of tax planning where you have a married couple and they are filing separately. Now, I know it might seem a little strange that they may file separately, but there are some really good reasons to do so. If that's the case for you, if you're married but filing separately, you're not eligible for any of the education tax credits. So that's going to be the American Opportunity Tax Credit or the Lifetime Learning Credit. So again, if you're single, you can qualify depending on income, and if you're married and you're filing joint, you can qualify depending on income. So how do you do that? Now, really, this is going to be a formality, I think, for most people. If you have a tax planner, they'll help you get through this. They'll have all the forms. They'll know what to do. Or if you're using something like a TurboTax or some sort of tax preparation software. But you may receive what's called a Form 1098T. It's a tuition form. And that's going to help you to understand what that's going to be your substantiation for when you file your taxes. Now, not every school is required to send one out. So just make sure that whatever other documents that you have from the school, keep those on hand so that you can substantiate that tax credit and your expenses, just in case the IRS does want to do some sort of audit, because occasionally it does happen. You're also going to need your institution's EIN number. And then again, if you're filing with a tax software or you have a tax preparer, they'll go ahead and have this ready for you. But you'll also include your Form 8863, which is for your education tax credits. The interesting thing here, and something that I think is important when it comes to claiming tax credits, is the timing of it. So sometimes you may end up paying for part of the tuition, say in December, and then the tuition, the semester is not going to start until January. So here in this example, you've paid $2,000 in December 2023, but the semester doesn't actually start until January of 2024. That's okay. You can still use that $2,000 in the qualified education expense for the 2023 tax year, as long as it's in the first 3 months of the following year. So January, February, March of the following year, that is perfectly fine. And ineligible claimants, as I mentioned, if you're filing separately but married, you are not eligible to take any of the education tax credits. In fact, there are plenty of tax credits and tax deductions that you're not eligible for. But that does apply here for the education tax credits. And if you're already claimed as a dependent on someone else's tax return, then you can't claim this tax deduction. So where would that come into play? Well, let's say that you, as the parent, have a student that is going to school, and you're paying for part of their education, but they're also paying for part of it. If you're claiming your student on your tax return, even though they have potentially eligible education expenses, they can't file as well. So it's likely going to be on your tax return. I won't say it definitely will, but you'll have to determine, whose tax return you're going to want to file, and if your student's going to be a dependent or if they're going to be independent. So there are some situations where somebody makes a payment, the student, for example, and they are not eligible to take it. So just be aware of that in certain instances. Also, if you were not issued a Social Security number or an ITIN by the time the tax return is due, then you're not eligible to take this tax credit. So anyway, I hope this helps give you a little bit of clarity as to the American Opportunity Tax Credit. As I said, I'm going to be doing another video on lifetime learning credit here shortly, so it'll give you an idea on how they're different. But I'm going to be putting out more videos here in the coming weeks, especially as we ramp up here with college planning season. And so be on the lookout for those. If you do want to know when we're going to have a new video, just hit subscribe so you get that automatic notification. But right now they're kind of coming in as I'm finishing up new presentations and recording them. I'm putting them out, but if you want to know ahead, right when they hit, then go ahead and hit subscribe. If you do have any questions, go ahead and reach out. And my email, my phone number are here. You can go on my website. You can book a quick appointment if you have any questions that you want to ask directly. So I'm here to help. And so I appreciate you taking the time to listen, and we'll catch you on the next video. All right. Thanks. Have a great day.